Okay, we are on corporations, and we're going to go through the chapter, and we won't be doing journal entries, but I will show them to you. I think right now what you need to concentrate on are balance sheets and the concepts. So, here we go. The learning objectives are to 1. Identify the characteristics of a corporation. 2. Account for the issuance of stock, just know how it's handled, and to account for the purchase of and sale of treasury stock, you need to know what that is, and then to also know about dividends, stock dividends, these are cash dividends, and stock splits. That's the main part, and then we're going to look at equity, how it's reported. We're going to look at some financial ratios, earnings per share, return on common stock or return on equity, and then the PE or the price earnings ratio. All three of those are really important, and you're going to hear a lot of people talking about them. So if you're in business, you need to have at least a passing acquaintance with those. So let's get started with the characteristics of a corporation. I think everybody knows that a corporation is a business that's organized under a state law as a separate legal entity, which means it has a life of its own. It's almost like another person. They're pretty dominant in the U.S., and the most well-known companies are called corporations. And we hear them all the time, and we talk about them and study them. So some of the characteristics: they're a separate legal entity, like a person. The only thing they don't have is a social number. They can have a number of owners. It's just not usually one owner that has the entire corporation. There's no personal liability for the owner, so that means that there's limited liability, and that the only thing that an owner puts up as risk is the amount of money that they've invested in the corporation. There's a lack of mutual agency, which means there are no contracts between the owner and the business, and it's just a lack of mutual agency. There's an indefinite life to this corporation. It can go on forever. It is taxed as an individual would be taxed, and sometimes more than an individual would be taxed. And it can accumulate capital, which means as it goes along and gathers profits, it's accumulating capital and worth as it goes. And the stocks can go up and have a higher market value than what you paid for them. So those are the characteristics. Those are unique. Now, some of those characteristics have advantages and disadvantages. They can raise more money than partnerships or proprietariships. They do have a continuous life. You can transfer ownership very easily among back and forth, total strangers, to your brother, to your sister, to your daughter. It's very easy to transfer ownership. There's no mutual agency, and stockholders have limited liability. Now that's the good part. The somewhat disadvantageous things about a corporation are the ownership and the management of the company are usually separated. So there's it's almost like a third-party ownership. The earnings of a corporation are subject to double taxation, which means if they distribute a dividend, that dividend is profit that's taxed to begin with, and then when it goes to the owners, it is taxed again via their personal income tax. And the government has a lot of regulation with corporations because they're traded to the public, and that can be expensive and time-consuming. And startup costs are higher because you're obviously pulling in more costs. It's a much larger operation than a small proprietorship. And those are the characteristics: advantages, disadvantages. I'm sure there are more, but those are the main ones. Here's your basics for equity basics. A corporation has authorized stock, And out of that authorized stock, there are issued stock. And the stock that is held by stockholders, okay, is called outstanding stock. So that kind of nests in there. So you have stockholders who are issued stock certificates, and capital stock, when it's listed, it represents the stockholder's ownership. Now, stockholders usually are not the managers. They just own an interest in the business or in the corporation. Here's an example of a stockholder's share. Now, this is hard copy. It shows hard copy, but usually anymore everything's done electronically, so some stocks are held electronically, and there are no certificates involved as this. You will see there's the company's name, the stockholder's name, and the number of shares held by the stockholder. Stockholders have rights. They have a right to vote for each share. They have a right to dividends when they're declared and paid. They receive their share of any assets remaining after liquidation of the company. And there's a preemptive right. They have a right to maintain their proportional ownership, which means if there's a dividend or if there's a distribution of stock, you've got to be able to maintain your proportion. If you have 50% at the stock dividend, you should have 50% afterwards. I mean, the proportion of your ownership should be the same or go up. You should never lose your proportional ownership. So you have capital stock. Okay, so now we're talking about the actual stock. You'll have common stock, which is what most of us work with, or there's preferred stock. And both of them can carry a par value. The preferred stock has some limitations to it, but they are guaranteed a dividend first before any other dividend is given to or declared for the common stock. There's a par value involved, which says the stock is worth this at the sale, or it's given an amount at the sale or the inception of the stock. And usually the amount is so low that the par value, the market price will never go below the par value. Or there may be no par value, which has no stated value or no stated amount. And then there's stated value stock. And this is no par stock that has been assigned an amount similar to par value. So it can get confusing. Typically par and stated are treated the same. And next up, we have stockholders' equity, and that is the amount of equity that a stockholder has within a company, and that would involve the common stock and paid-in capital, and the retained earnings that are all grouped together under stockholders' equity. Two basic sources are paid-in capital, which we get from selling stock, which you get when you buy stock, and retained earnings, which is a residual of the profits that are earned each year by the corporation. And then we look at journalizing the issuance of a stock. And I'd like to say this is just accounting for the issuance of a stock. I'll show you the journal entries, but I think it's more important that you understand how the stock is going to be represented on the balance sheet and on other statements. So how is it accounted for? First of all, we raise capital by issuing stock, and the company can sell the stock directly to the stockholders, or it can use the services of an underwriter. Now, typically, they will use an underwriter. Stocks of public companies are bought and sold on stock exchanges, such as the New York Stock Exchange, which is a physical stock exchange, or the NASDAQ, which all of their work is done via telephone and computer. And in fact, a lot of the New York Stock Exchange is now computerized. There's talk of the ticker floor going away and being closed down this year. And then there's the issue price, and that's the amount the corporation receives from issuing the stock. So let's look at what that really looks like. So they've got common stock, and there's a par value of $1 per share, and it authorizes 20 million share, and the stock issuance of 15,000 share is shown below. So they issued it at par value, and they issued 15,000 share, which means it's worth $15,000. So the company receives $15,000. It shows a credit of owner's equity of $15,000. Now that is for par value. You'll notice it's just a straight out deal. Now here they issue the same kind of stock for $3,000, but they're paying $5 a share. There's a $4 difference, and that's called a premium. That premium, that $4, is going to go into paid-in capital in excess of par. So now we come back and we show cash, a debit of $15,000, but we show $1 par, and we're going to multiply that times 3,000 shares, so that goes right into common stock. But we're splitting out that $4 difference, and that becomes the paid-in capital. So now we have common stock 3,000 and paid-in capital of 12,000. And usually that is, and this is how it looks on the balance sheet. You have paid-in capital, so you've got common stock showing at 18,000, which means there's 18,000 $1 par released, and here's the additional, or in excess of par, that was paid, that $12,000. That gives us total paid-in capital of $30,000, and then the retained earnings of $35,000. This is what I want you to remember. I want you to be able to read this. If somebody asks you, what does this mean? And what is this paid-in capital? So remember this, and we're going to keep going here. Now, if you issue no par common stock, you never have that in excess of paid-in capital. So no matter what they pay for it, it's just going to be a straight 15,000, 15,000, and then a recording of the share, just so you can keep track of the number of shares you have. And that looks like this on a balance sheet. You have your paid-in capital of 30,000, says 18,000, right? No par. It gives you the shares issued and outstanding and the amount, and then the retained earnings and the stockholders' equity. Same amount here, except for it's separated out differently. And then the next one they look at is stated value. Remember I said it's treated just like par? And that's exactly what you'll see here. You'll have the original, the cash. You'll have the common stock, and then you'll have in excess of stated rather than par. And this is issuing common stock for something other than assets, and that's just a simple, somebody gave you furniture worth $18,000, so you're going to split it out the same way. Only instead of hitting cash as your asset, it's going to be furniture. And this one is looking at preferred stock, and it's 6% preferred stock. So they sold $55 per share preferred stock for $55,000, and it was $50 par stock. So it's going to show the preferred stock at $50,000, and then in excess of par for preferred at $5,000. And that's going to look like this on the balance sheet. So it looks the same, it's just the terminology that's being used here. So now you have your preferred stock and you have your common stock listed, and then you have your retained earnings listed. So it's how it looks on the balance sheet that is so important. So objective 3 is treasury stock. And treasury stock is when the company itself buys back common stock that's on the market. And that's either because it's very low and it's a really good buy, or they want to pull in the amount of shares out so that they can support the stock price. So you've got an increased net assets by buying low and selling high. It's a good deal. You want to support the stock price by getting some of the stock off. You want to pull in shares to keep from having a takeover. Okay, you want to get the proportion of shares that are out on the market down so that you have a higher percentage. And sometimes you will pull in treasury stock like this, or common stock, so that you can use it for stock options for good employees. Reasons for it. It's a normal debit balance, okay, because it's a contra account. It's going against your common stock, which has a credit balance. It's recorded at cost, okay, without reference to any par. And the treasury stock account is reported beneath retained earnings as a reduction to equity. So that's taking that out of stockholders' equity. But it is recording it. So let's kind of look at how this is handled. So here they are purchasing and they're paying $5 a share for it. And they bought 1,000 stocks, so obviously it's a credit to cash and a debit to treasury stock. Now here they've turned around and they're selling it. And they are selling it for $5. So it's just a very simple transaction. They paid $5 for it, so everything's even up. Now here, they're selling it for $6. Now this is where you have to keep track of stuff. Number one, you're going to receive $1,200 in cash. You're going to take that original $5 that you had times 200 share and take that out of treasury stock as a credit. But you've got to record the difference. You actually made money on this, but you're going to record the difference and call it paid-in capital from treasury stock transaction and credit it and keep track of it in that manner. So the cost becomes how you determine the gain, or not a gain or a loss, but the addition to paid-in capital or subtraction from paid-in capital. This is, I think we just did this one. Let's look at this one. They're selling it below cost, okay? See now how they're subtracting it from paid-in capital here now, from treasury stock, so it's going to show as a debit. And that would show in the equity accounts. I believe it's, we'll see where I think they take it off of retained earnings. It's handled in different ways by different companies. So let's come down here and look at this. And they sell it for $4.50. And now we had $5 a share, okay? So now we're taking, we have, let's go back up here. In this account, you had $200, okay? Paid-in capital from treasury stock. In this, we took $140 out of that. Now, we need to take, and that would leave us how much left? $140, that would leave us $60 left in there. So now we come down and we sold it for $4.50. And we actually have a deficit of $100. So we can take as much as we can out of the one paid-in capital, which is $60, okay? And now, I've still got $40 that isn't accounted for here. That would come directly out of retained earnings. And then you would credit the $1,000 to empty out the treasury account. Treasury stock account. That's a bit confusing. You're not going to have to do many of those, but I wanted you to see that you can have additional paid-in capital from treasury stock, and you can end up having to debit retained earnings if you sell it for too much of a loss, because that's what it is. And this is the way it would look on the balance sheet. Here's your preferred stock, your common stock, your retained earnings, and this is saying that we have $1,500 worth of treasury stock to take out of stockholders' equity. And this is how it nests out. You've got them authorized, you have them issued, and then you have unissued shares. So treasury stock, okay, comes out of the issued, which means outstanding is for your stockholders, and treasury stock, which is part of issued now, shows what's been pulled out of the issued. So that's kind of the way, that's a very good flow chart to help you understand how that works. And I'm going to stop right here because we're coming up on dividends, and they're going to take just a little bit, and I don't want you sitting for much over 20 minutes as you're watching these. So I'll be right back with part 2 of corporations.